Welcome back. So we've been telling you that cues across Asia are mixed. It's not a one-way move that we're seeing. Some of the, Chinese markets, mainland China, Hong Kong, they're higher, but Japan's down. So let's see. We'll get the implied open up for you on the screen. The global backdrop is slightly confusing this morning, 25 points higher as far as the implied open is concerned. It's all about individual stocks, and there's so many of them to go over. So let's straight away go across to our team for the CNBC-TV18 list of top stocks to watch. Guys, morning to all of you, and happy Friday, first of all. Mangalam's been looking at lots and lots of numbers coming through. Let's start off first with ITC, Mangalam.
Well, for ITC, I expect the stock to be in the green largely because of the one key factor. The cigarette volume growth in the company this time around has been 5 to 6%. The street was working with a number of 3 to 4%, so that's a positive surprise. Though the negative, if you look at it, the FMCG revenue grew just 4% versus expectations of 5 to 7%. And out there, the margins collapsed by about 240 basis points because of high inflation. But that was something that the street was expecting given the other FMCG company numbers as well. Agri-business revenue grew about 10% with margins at around 12.3%. The margin improvement out there was a positive even though the revenues were shy of expectations. The paper business has been subdued but does not account for too much in their overall business as well. The net profit was boosted by 528 crore exceptional gain on account of them acquiring HLV shares from one of their subsidiaries. The demerged entity, the ITC Hotels business, showed a revenue growth of 15% and margin expansion of 450 basis points as well. So ITC Hotels likely to be in the green today as well. Apart from the numbers, the company has gone ahead and acquired Mitigo and Prasuma. The combined revenue of these acquired entities is close to 131 crores. They will be paying about 131 crores, in terms of 44% stake upfront, and thereafter they'll, acquire the remainder over the next 2 years. But the positive surprise on cigarette volumes should keep the stock afloat today. See green there.
All right, Mangalam, thanks a lot for that. Well, let's hop across to Rima. She's tracking the Bharti twins, Bharti Airtel, as well as Hexacom. Rima, tell us more.
Well, both the numbers are strong. So the industry is still benefiting from the July tariff hike. So first on Bharti, top line growth of about 8% on a quarter-on-quarter basis, margins expanding to 54.5%. Big jump in the company's profitability by more than 300% sequentially, but that is aided by an exceptional gain of 7,500 crore due to the consolidation of Indus. Look at the internals. Now, the India mobile revenue, which benefits from the July tariff hike, second consecutive quarter of strong growth, top line growth of 5.8%. Now, this is ahead of Reliance Jio's growth of about 3.5%. ARPUs are now at 245. So now they're getting closer to their aspiration of 300 rupees. And the positive is that subscriber growth, which declined in Q2, has picked up to about 5 million sequentially. Hexacom too is benefiting from those tariff hikes. Again, strong top line growth, 7% quarter on quarter. There is a jump of nearly 20% in their ARPU on a year-on-year basis. The company is adding subscribers by 0.8 million. So again, that is a good set of numbers. And just one final word, there is an announcement that Indus Towers will be acquiring 16,100 towers from Airtel and Hexacom, and they will be paying about 3,300 crores for the same. Back to you.
All right, Rima, thank you very much for that. So keep an eye out on these names as we open up. Well, Britannia is the next one. We were talking about the expectations yesterday. Mangalam is here with the numbers. Mangalam, morning.
Good morning. So, Britannia seems to be one of the best numbers that have come by in the large consumer companies so far. It's a solid beat across all parameters. Revenue is closer to 4,600 crores. Street was working with a number of 4,500 crores. EBITDA, 845 crores. We were working with a number of 780 crores. So margin was a beat, and the net profit on account of that, 582 crores versus expectations of 534 crores as well. Domestic volume growth came in at 6.5% versus expectations of 4 to 5%. So that's telling you, this company is doing well, at least in the rural areas. The only important thing to track is, one, gross margins. They've compressed by about 500 basis points, and employee expenses have halved. So, it's halved both quarter on quarter and year on year. That's aided the EBITDA. So how much of that is sustainable or not, or what was the reason behind that, is something we'll be tracking. There has been inflation in key inputs, and the management said that their focus states, which is Bihar, Uttar Pradesh, Rajasthan and Madhya Pradesh, all of them have grown 2.5 times their company average, and their adjacencies, the likes of croissant, dairy drinks and wafers, doing well too in double-digit growth. So expect Britannia shareholders to have a good day.
Absolutely. I think they will, considering volume beats are a rarity in the FMCG space these days, and Britannia has managed that. Mangalam, thanks very much for it. Let's go across to Vinny. Vinny, how were the numbers for Aurobindo Pharma?
So Aurobindo Pharma revenues were largely in line, but we saw a miss coming in on the margin as well as the profit front. So let me take you out to the key negatives and positives. What we're seeing is PAT was a miss because higher interest costs is what we saw coming in and lower other income impacting the profitability of the company. UGR US sales, that doesn't seem to be that great. We're seeing a bit of a decline that has come in on a sequential basis, and API sales are seeing a decline. The pricing pressure continues, 1.6% decline on a year-on-year basis. Sequentially also, we're seeing a sharper fall coming in. API accounts to around 13% of the total sales. Now positives, the ARV sales, that show a very, very strong growth, 72% growth on a year-on-year basis. Europe as well as the rest of the world performance was very strong, whether you look at it sequentially or on a year-on-year basis, delivered strong growth in its US oral portfolio. Now that has managed to see a good growth, so supporting the overall growth for the company. So overall, when you look at it, largely the positives are outweighing the negatives, and that is why we're expecting green coming in the stock. Do not forget, Aurobindo Pharma had seen a fall coming in the last 1 month also, so maybe we could see that positive sign coming in for Aurobindo Pharma.
Vinny going with green on Auro Pharma. Noted that. Vinny, thanks a lot. Well, let's hop across to Sudarshan. He's here to tell us about Hero MotoCorp. Sudarshan?
Good morning, Nigel. So it's a good set of numbers from Hero MotoCorp for Q3 FY25. And remember, in the last few months, stock has fallen more than 30% from its record high. And what has worked for the company, it seems that company has taken price, and because of that, realization has improved both sequentially and year on year. And also festive season demand has worked most for Hero MotoCorp because it holds a large chunk of market share in the entry-level segment. And this segment, market share for entry-level segment, has gone by 6.5% if you compare year on year. Talking about the main numbers, revenue was up 5%, EBITDA has increased 8%, and margin too holds above the level of 14%. It has come in at 14.5% versus 14% same quarter last year. Earnings call is scheduled at 10:30 a.m. So we'll have to see what exactly company says on demand front. But on the back of earnings, I'm going with green for Hero MotoCorp.
All right, so thank you very much for that. PI Industries is the next one. A well-tracked, well-owned name. Vamakshi is here with numbers. Vamakshi, morning.
Good morning, Prashant. A weak set coming in from PI Industries this time around. When you look at the revenue, it came in at 1,900 crores. This is largely flat on a year-on-year basis and has come in nearly 2% below consensus. When we look at the EBITDA margin, that has contracted by nearly 224 basis points to 26.9%. This is again lower than what the street was anticipating, and this decline in the EBITDA margin is largely being led by cost of goods sold, which have seen an uptick of nearly 2%, and other expenses, which are seeing an uptick of almost 8% as compared to flat revenue growth. When you look at the net profit, it has come in at 373 crores. This is a decline of almost 17% on a year-on-year basis, so not boding well for PI Industries. Segment-wise, agrochemical segment saw an uptick of 4%, but the pharma segment saw a very substantial dip of nearly 50% from 127 crores to 63 crores. The agrochem EBIT margin also came in under pressure, down nearly 154 basis points, and the pharma business reported an EBIT loss of almost 56 crores. This has expanded from the same quarter last year. So overall, when we look at the numbers for PI Industry, not a great set coming in, and resultantly, I'm going with a red for this counter.
Yeah, so absolutely, Vamakshi got it. What this quarter has told us that it's not the same situation for all chemical stocks. It's different for different sectors and different chemical industries, and PI has not had a great quarter. Got it. Quickly moving on to Apollo Tyres. We've got Sudarshan back with us. How are the numbers, sir?
Good morning, Surabhi. So it's a weak set from Apollo Tyres. Company has missed even muted expectations. So basically, it has two major segments. One is APME, that is basically Asia, Pacific, Middle East, and Africa, and second is Europe. So APMEAC region, for this, EBIT has almost halved. It's down 50% if you compare with the same quarter last year. Europe business EBIT has come down, but remains steady. Now talking about the numbers, profit was down 32%, revenue has increased 5%, but overall EBITDA has fallen 22%, and margin has come in below 14%. It's at 13.7% versus 18% same quarter last year. Even it has missed expectation, and expectation was of 14.4%. For Apollo Tyres, earnings call is at 3:30 p.m. So we'll have to see what exactly company says on APMEA region, because that is one reason which is a major drag for the company in Q3. I'm going with red for Apollo Tyres for that.
Got it, sir. Thanks for that. Upasana, let's wind this down with Kochi Shipyard and PG Electropast.
Good morning. First up, let me start with Cochin Shipyard. Company's reported weak set of numbers. This was mainly dragged down because of the company's key segment, that is shipbuilding segment, while company's ship repair segment outperformed this time around. Now, overall revenue growth stood at 9%. Mainly, this was because of the shipbuilding revenue, which was down about 14%, while ship repair, as stated earlier, saw strong growth. Revenue was up about 65% on a year-on-year basis. Now, EBITDA margin saw a downtick of 870 basis points, stood at 20.7%, and PAT also saw a degrowth of 27% on a YoY basis. On the flip side, PG Electropast reported a strong set of numbers. Numbers were above street estimates, driven by the company's product business. Revenue EBITDA margin was above, while PAT was in line with the street estimates. Mind you that the company has raised its revenue and PAT guidance for FY25. Coming to the numbers now, revenue stood at 968 crores, which was up 82% on a YoY basis. EBITDA margin saw an uptick of 90 basis points, stood at 8.8%, which was much above the street estimates of 8%. And PAT saw an uptick of 1.09 times and stood at 40 crores. Now, as highlighted earlier, company has raised its guidance. Now, there is a 7% upward revision in the revenue guidance, which now stands at 4,550 crores, and 12% increase in the PAT guidance, which now stands at 280 crore. So, strong set of numbers from PG Electropast, while Cochin Shipyard, weak set of numbers.
Okay, all right, got it. Thanks very much, Upasana. So both of those on our radar as well.